Welcome to today's explainer, Choice Properties REIT, stable giant or overleveraged income play. Today we're unraveling the mystery of one of Canada's absolute largest real estate platforms. On the surface, you've got this really attractive 5% yield, right? But we need to figure out if that yield is a genuine reward or honestly a massive red flag hiding behind a familiar grocery store logo. Let's get right into it. So here's our game plan for today. We'll start with a business summary and intrinsic value, do a deep dive into business operations, and then look at financial health. After that, we'll run a SWOT and scenario analysis, map out buy prices and target returns, and wrap it all up with our final verdict and scores. All right, starting with our business summary and intrinsic value. So what exactly is Choice Properties? Well, it's a massive Canadian REIT heavily focused on retail and mixed-use properties. And they bring some serious defensive traits to the table. We're talking about raking in over 1.41 billion Canadian dollars in steady, predictable revenue. The main engine driving all this? A heavy concentration of assets tied directly to Loblaw, which is one of Canada's largest grocery retailers. And, because food retail demand stays incredibly stable even when the broader economy gets rocky, this gives Choice Properties a distinctly semi-defensive profile. But here's where things get really interesting. The stock currently trades around $15.22, but if you look at the net asset value, it's sitting way down at just $12.27. That means the market is pricing this REIT at a massive 24% premium over the actual underlying real estate. And it doesn't stop there. The funds from operations fair value drops all the way down to $6.84 using a 12x multiple. Even the implied yield fair value caps out at $13. Across the board, the data is strongly suggesting this asset is overvalued right now. Let's move on to our deep dive into business operations. On one side of the coin, we have an undeniable competitive moat. Think $17 billion in total assets, plus those super stable Loblaw grocery anchors practically guaranteeing consistent foot traffic. But we really have to weigh that incredible stability against some growing complexities. They suffer from severe tenant concentration risk. A huge chunk of their revenue is tied to just one corporate entity. Plus, they're pivoting toward highly complex mixed-use developments, which naturally carries much higher execution risk. Which brings us to the management team and the overall investment thesis. Now, management is definitely competent, but they are aggressively pursuing a capital-intensive growth strategy with these new mixed-use builds. They're basically trying to pair their incredibly stable retail income with the much higher leverage needed to build residential towers. Because of this major strategic shift, our investment thesis is pretty clear. This is no longer just a simple deep value play. It's a highly complex hybrid, and it requires very careful monitoring. Okay, let's look at the other side of the balance sheet with our financial health deep dive. The absolute most crucial point here is this staggering 166% dividend payout ratio based on adjusted funds from operations, or AFFO. What does that actually mean for us? Well, it means that after paying for the essential maintenance to keep their buildings running, they are literally paying out significantly more cash in dividends than they're generating from operations. This disconnect is a huge problem. It immediately threatens the long-term sustainability of that attractive 5% dividend yield. And honestly, it gets worse. We're looking at a massive 276% debt-to-equity ratio. To put that into perspective, that's about $6.8 billion in total debt, which severely stretches the balance sheet. Now, sure, their massive asset base gives them a little bit of breathing room, but carrying this level of leverage in a world of fluctuating interest rates, that's a screaming risk that conservative investors simply cannot ignore. So when we run our red flag scan, any margin of safety pretty much completely evaporates. You're looking at a toxic combination of weak cash coverage, massive leverage, questionable dividend sustainability, severe tenant concentration, and elevated development risks. This whole combination demands extreme caution. Let's pull this together into our SWOT and scenario analysis. Breaking everything down into a weighted SWOT model, we see a real tug-of-war. You have the immense weight of their strong tenant base, massive scale, and stable revenue constantly fighting against the heavy drag of high leverage, overvaluation, and development risk. The math spits out a fairly mediocre total score of 5.5 out of 10. The strengths are definitely there, for sure, but those glaring weaknesses pull them right back down to average. If we project out what the intrinsic value might look like under a few different conditions, our bear case, where FFO drops by 10%, plummets the value to between $10 and $12. Our base case, assuming stable FFO, puts the value between $13 and $16. And even our absolute best case, bull scenario, assuming a 4% annual growth, only pushes the value up to between $16 and $18. Considering the stock is currently trading above $15, even our base case leaves very, very little upside room from today's price. Next up, let's talk buy prices and target returns. Our primary goal here is to double our money multiple times, specifically aiming for a 9% average annual return over 16 years. If your goal is to hit that exact 9% return, the math dictates a strict buy price of $13.60. Buying anywhere above that mathematically compromises your target. We also pair this with an exit strategy. If you do buy at $13.60, you'd want to start trimming your position if the price hits between $17 and $19. Let's see how this required buy price shifts across different time horizons. Say you only want to hold the stock for 5 years and hit that 9% return. You could technically justify paying $15.80 today. But as your timeline stretches out to our goal of 16 years, your required buy price drops down to $13.60. Basically, the longer you need the money to compound, the wider the margin of safety you need up front. Finally, it's time for our final verdict and scores. Our calculated risk score sits at an elevated 6.3 out of 10, and that is almost entirely dragged up by that massive debt load we uncovered, plus the precarious AFO dividend payout coverage. The very real risk of a dividend cut or having an over-leveraged balance sheet in a tough rate environment acts like a heavy anchor on this stock. Contrast that with an opportunity score of 6.0 out of 10. This perfectly balances the slow, defensive, sleep-at-night grocery stability against the highly ambitious but risky upside of their mixed-use residential expansion. So the opportunity is solid, but it certainly doesn't eclipse the risks involved. If we were to look at this through the lens of legendary investors, Peter Lynch would likely classify this as a classic slow grower with fantastic tangible asset backing. However, Charlie Munger would undoubtedly throw up a massive caution sign regarding that extreme leverage. It's a real push and pull between fantastic real estate and questionable financing choices. So bringing it all together, our final takeaway for conservative investors targeting a 9% return is a definitive hold. At current market prices, the margin of safety is simply too thin to justify a new position. You're better off waiting patiently for a drop below $13.60 to secure a true margin of safety that actually accounts for their massive debt and high payout ratio. I hope this explainer gave you an objective roadmap on Choice Properties REIT. So I'll leave you with this final thought. Is a 5% dividend yield really worth the sleep you might lose over $6.8 billion in debt? Let me know your thoughts in the comments. And while you're there, tell me, which stock do you want me to analyze next? Thanks for joining me today, and keep your focus sharp.